Hey everyone, and welcome back to Savvy Nomad's channel. If you're new here, we help digital nomads and expats navigate the complicated world of international taxes, residency, and living abroad. Today we're going to talk about common expat tax mistakes that could cost you thousands of dollars or even land you in serious legal trouble. More importantly, we'll tell you how to avoid them so you can file taxes this year without any hiccups. Let's dive in. So maybe the number one mistake for US expats living overseas is thinking that they don't have to file taxes at all. I know it sounds crazy, but you'd be shocked at how many people living overseas genuinely believe that just because they're not in the US that they don't need to file US income tax returns. But in all fairness, I kind of do get where this confusion comes from. Most countries in the world use what's called residency-based taxation. So, if you're a French citizen living in Spain, France doesn't tax you anymore on your income, Spain does. But the United States is special, and by special, I mean that they're one of only two countries on the planet that utilizes citizenship-based taxation. So if you're an American citizen or a green card holder, you need to file US tax returns no matter where you live, no matter where your income is generated, and no matter how long you've been out of the country. Now, keep in mind that if you're self-employed, which many digital nomads and expats are, then you will need to file a tax return once your net earnings hit just $400. On top of that, you're still on the hook for that 15.3% US self-employment tax even while you're living overseas. That still covers Social Security and Medicare. Now, some countries do have what are called totalization agreements with the US, which basically means that you can avoid paying into both systems. But you do need a certificate of coverage to prove where you're contributing, and a lot of expats don't even know this exists. That brings us to mistake number 2, which is ignoring the 183-day rule. Okay, so you know you need to file US taxes. Great. But did you know that staying too long in one foreign country can also make you a tax resident there? Most countries around the world use what's called the 183-day rule for tax residency. 183 days is, of course, half a year, and it's pretty straightforward. If you spend 183 days or more in a country during a tax year, boom, you're now a tax resident of that country, and you need to report your worldwide income to them. Now, some digital nomad visas or residency permits do offer temporary tax breaks or exemptions, so make sure you watch our recent video on that topic. Check out our playlists. In general, though, if you're planning to stay somewhere for an extended period, you need to track your days carefully. Mistake number 3 is choosing the wrong expat tax benefit or not using one at all. This is huge, and it's where we see people leave the most money on the table. Now, despite the fact that the US taxes expats and nomads on their worldwide income, it does offer some generous tax breaks, and the two big ones are the foreign earned income exclusion and the foreign tax credit. But here's the thing, you need to know the differences between these two provisions, and you have to actually claim one of them on your tax return. Let's start with the foreign earned income exclusion. This lets you exclude up to $130,000 of foreign earned income from your US taxable income for the 2025 tax year. But to qualify, you need to meet one of two tests: physical presence test or the bona fide residence test. Again, we have multiple videos on the foreign earned income exclusion as well as individual videos on those two tests, so make sure you check out our tax playlist. Now, the other big option is the foreign tax credit. This gives you a dollar for dollar credit on income tax that you paid to a foreign government. In other words, if you paid $10,000 in taxes to Spain, you can claim a $10,000 tax credit against your US tax bill. Mistake number 4 is not understanding foreign bank account reporting requirements. Alright, so this one is actually very serious. We recently covered the case of the expat couple in New Zealand that got sued for millions of dollars by the US Department of Justice, all because they failed to report their foreign bank accounts to the US government. That's it. They weren't hiding money, they weren't evading taxes, they just didn't file the forms. Here's what you need to know. If your combined foreign bank account balances exceed $10,000 at any point during the year, you must file what's called an FBAR. And the key word here is combined. A lot of people think mistakenly that each account is assessed separately, but that's not how it works. If you have $5,000 in a bank in Portugal, $3,000 in Thailand, and $4,000 in Mexico, you're over the $10,000 limit and you need to file. Mistake number 5 is overlooking state tax obligations. Some states, particularly California and New York, are particularly aggressive about pursuing former residents for state taxes. If you move abroad but you still maintain certain ties to the state, they can argue that you're still a tax resident even if you're physically living somewhere else. One of the best solutions here is to establish a domicile in a state with no income tax at the personal level before you move abroad. At Savvy Nomad, we actually do specialize in helping expats get properly domiciled in Florida, which has no personal income tax and is very clear about its residency requirements. Check out the link in the video description if you're interested in learning more, and make sure you use the code YouTube for a discount. Mistake number 6 is confusing personal and business expenses while living overseas. If you're self-employed as a digital nomad or you run a business as an expat, then you can in fact reduce your US tax bill by a lot if you deduct necessary expenses for business purposes. The problem is a lot of people are a bit confused about what actually qualifies as a business expense versus a personal expense. Just because you're working while traveling doesn't mean every single thing is deductible. That flight to Bali, not deductible, unless you're traveling there for a business meeting or some kind of client work. Now, if you want more detailed guidance on any of these mistakes, we just released our free 2026 Expat Tax Guide. It's packed with information on the foreign earned income exclusion, the foreign tax credit, state domicile, and all the forms you need to file. You can grab it by signing up for our free email list. Link is in the video description. And if you want to make sure you're doing everything right, and to be clear, we do advise that you speak with a tax professional before you make any major decisions, then check out Savvy Nomad's tax preparation services, which we offer to our clients. Again, link is in the video description. Thanks so much for watching. If you found this video helpful, make sure to hit that thumbs up, helps us out in the algorithm, and subscribe because we're always putting out new content for expats and nomads so you can save money and live better abroad. Thanks for watching, and we'll see you in the next video.